Hi everyone, this is Patrick from AllQuant. The latest FOMC minutes will be released in a few hours' time. It is supposed to shed more light on the Fed's thinking regarding future rate hikes. Here, I'll just like to share some thoughts about where we are today. The first chart here is probably the most significant of all the charts that I am going to present. I have superimposed the historical Fed funds rate on top of the historical CPI, going all the way back to the 1960s. The blue line is the CPI, while the orange line is the Fed funds rate. You can see that the Fed funds rate tracks the CPI very closely. In fact, during the great inflation of the 70s, the two are almost in line. The Fed funds rate is higher than CPI most of the time before the Great Recession in 2008. With the loose monetary policy post-2008, the Fed funds rate became lower than CPI most of the time. The gap widened significantly this year due to the inflation unleashed by the effects post-COVID-19, as well as the Russian-Ukraine war. Despite headlines suggesting aggressive Fed action, the fact is that the Fed is still significantly behind the curve on inflation. The gap has to close eventually. So the question is whether the Fed funds rate has to rise at a faster rate to catch up to CPI, or the CPI can crash down to meet the Fed funds rate. Which is more likely to occur? In my opinion, I think the Fed funds rate has to rise up significantly more in order to arrest inflation. Ever since the last FOMC meeting in July, where market participants interpreted Jerome Powell's statement as dovish, risk-on sentiments have fired up. The S&P 500, as represented by SPY, extended the strong rebound since the middle of June. The rebound was so strong that it is looking a little stretched at the moment. Turning to the bond markets, yields have increased drastically in the first half of this year. Nominal bonds, as represented by IEF, dropped a lot more than inflation-protected bonds, as represented by TIP. Recently, however, yields have stabilized somewhat. IEF clawed back the underperformance and overtook TIP. As it stands, IEF is trading slightly higher than TIP for this year. This is a positive development with regards to inflation expectations. However, it is still too early to conclude that inflation is under control. Broad-based commodity prices are still in a holding pattern as represented by DBC. Take note that DBC is mainly driven by oil and energy prices, which makes up roughly 60% of DBC. Although DBC has come down from its high reached in June, we need to see it break out of the trading channel to the downside convincingly. Agricultural commodities, as represented by DBA, have also come down from the peak in June, but it looks like it is moving in an uptrend channel recently. Again, we need to see it break to the downside convincingly. The 5-year break-even rate is the market's expectation of the annual inflation rate over the next 5 years. It has come down from a high of 3.5%, but it is still some ways from the Fed's neutral rate of 2%. The conundrum here is that risk-on sentiments can prevent inflation expectations from coming down. The reason why the 5-year break-even rate could come down since March was because the market was pricing in recession risk. If the market now thinks that recession is off the table, as what stocks is suggesting, then it might be difficult for inflation expectations to come down. We now turn to the king dollar. The US dollar has been on a strong uptrend since the beginning of this year. It lost some of its strength after the July FOMC as the market priced in a potential Fed pivot. However, it seems to be moving up again. The direction of USD is important because it is a global trade currency and many things are priced in USD. So if the US dollar becomes too strong, it has the effect of tightening monetary conditions. It also has the potential to trigger debt crisis in other parts of the world if the foreign debt is priced in USD. This is because the interest financing as well as the principal needs to be repaid in US dollar terms. The chart here shows the yield differential between the G3 countries. As you can see, there is still a wide gap across the yield curve between the US and both Japan and Germany. This is probably a major contributor to the weakness in the euro and the yen, which makes the USD strong by comparison. Okay, that's all I wanted to cover for this episode. Stay safe, everyone.